Okay, I'm Sky Moore. This segment is on choice of entity. That is, what kind of entity should you use to do whatever it is that you're planning to do? So let's roll through the various alternatives that you have and just briefly describe their benefits or detriments, and so that you'll know what to use. Simplest entity is really a non-entity. That is a sole proprietorship, also called a DBA, doing business as, and that's just yourself. You operate as an individual, in maybe an independent contractor, and you could be a professional or a consultant. No reason not to do this. If it works for you, particularly if you're the everything that's doing whatever it is, you will not avoid limited liability. You will not have limited liability by using an entity. There's no point to use a corporation or an LLC because people will sue you personally. So if you're the consultant, lawyer, professional, whatever it is, use a DBA, no harm. Second up in complexity is a partnership, general partnership. And if you are acting with somebody else and you are sharing net profits, then by definition, by state law, that is a partnership. You might as well face it and use a partnership agreement. And the simplest one is a general partnership agreement. You're both liable for the debts of the entity. It requires your mutual consent to basically do almost all significant actions. The detriment of a general partnership is that you are personally liable if your partner does something stupid on behalf of the partnership. And so the next level of complexity is a limited partnership, which is a partnership where one partner is the general partner and the other partners are limited partners. Limited partners have no liability for the debts of the partnership. They generally have no control. They cede management to the general partner. As with a partnership, it is a pass-through entity for tax purposes, so the profits and losses flow through. There's only one level of tax imposed at the partner level. It is a relatively simple entity to use. The only downside of a limited partnership is that there has to be one general partner, or one or more, and that general partner is liable for the debts of the partnership. And so often what you see when you do see a limited partnership is that the general partner comes in as an entity, as some kind of corporation or LLC that has itself limited liability, and it is so that you achieve the overall result of limited liability. The next step up, which is simpler and achieves the same result, is a limited liability company, or an LLC. And that is, it's like a limited partnership, but there are no general partners. Everybody has limited liability. It is a pass-through entity for tax purposes, and so therefore there's only one level of tax, and it has limited liability for state law purposes. So because of its efficiency and simplicity, this has become the entity of choice for most people, most of the time, anytime when you have multiple partners or multiple investors. The only downside to an LLC is in California, there is a gross receipts tax. It caps out at about $13,000 if you have about more than $5 million of gross receipts. A little bit annoying, so sometimes in California you might use a limited partnership. The next up in complexity is what's called a C corporation, which is a corporation that for tax purposes is subject to its own level of tax. There is a significant detriment to using a C corporation, which is it has taxed at the corporate level and the shareholders pay tax when the profits are distributed as dividends. So it has double tax, and the losses of the corporation don't pass through to the investors, so that whatever they've invested, they can't deduct, and that's not a happy day. So in general, C corporations are not a vehicle to use. The only exception is if you are using it as what's called a loan-out corporation. You're a professional actor, director, producer, writer, and you want to run your compensation through a corporation so you can deduct all your goodies, maybe have a pension plan, maybe deduct health insurance, and then you use a loan-out corporation and you avoid the double tax problem by draining out all the compensation every year, all the profits every year as compensation to you. And so the corporation doesn't pay tax because it deducts everything as compensation to you or deductible pension plans, and so it runs at a zero. Finally, the last entity that you could use is called an S corporation. It's a corporation, but it elects to be treated as a pass-through for tax purposes, and it has therefore the one level of tax benefit of the partnership and LLC. It has limited liability like an entity. The downside of an S corporation, however, is that it has to be only common shares. You can't do special allocations. You can't say John gets his money back first and Bob gets money back second. And everyone has to be United States citizens or residents, and they have to be individuals. You can't bring an entity shareholder. So it's like being in a straitjacket. So in general, you don't want to use an S corporation. If you're going to go in that direction, you might as well use an LLC. It's going to be much simpler for you. So in most cases, for most film financing, you want to use a limited liability company, again, unless you're a loan-out corporation, in which case you're a professional, and then you would normally want to use a C corporation.